Mr. Sreenivasan of Bajaj Finserv. Mr. Sreenivasan, good morning and thanks so much for being with us. Let's first talk about the consolidated profits, seeing a marginal growth, while of course Bajaj Finance has reported strong profits. What's led to the degrowth on the general insurance side?
Well, general insurance, if I look at the growth, that has been fairly strong. We have grown 17% on the gross written premium. However, on the profitability side, we had 2-3 one-off events which actually affected the profits. Last year, we had written crop insurance in the Rabi season. So this year, we had extra underwriting losses of 98 crores because it turned out to be crop insurance is like that. You do get large losses because of weather. So there were about, and the losses are determined a couple of months after the end of the year. So we lost about 98 crores extra there. We had another 30 crores of losses from the cyclone Fani, which hit the east coast of India early in the quarter. These are the two major reasons. There is also a slight uptick in our motor own damage claims. But as we go along, we hope we'll be able to correct that. So if you exclude these one-off events, I think the result, underlying result has been quite strong. Obviously, on the investment side, we have, as a measure of abundant caution, taken a call to provide for 60% of our exposure to DHFL, which affected Bajaj profits by about 76 crores in this quarter.
What's your total exposure now for to DHFL, and how much more provision is needed? Any other stressed accounts as well that you could share details on with us?
See, we had last year provided 100% of our exposure to ILFS. DHFL in Bajaj, in the general insurance company, we have provided 76 crores, which is 60%. The total exposure is 123 crores. This is all in non-convertible debentures. In the life company, we have provided in this quarter 126 crores, which is 60%. The total exposure, which is on the shareholders' account, is around 210 crores, out of which 50 crores is in CPs, which they defaulted in the end of June. And otherwise, the rest is in NCDs, which will fall due over the next 2 to 3 years.
Talk about general insurance.
Other than that, stressed accounts, we actually every quarter publish
Please go ahead.
We publish every quarter in the insurance companies, in our public disclosures, a list of downgraded securities. So some of them are not as of today stressed. So we have a watch list which we keep watching very closely, and we are deeply engaged with the companies to understand the moves there.
Could you highlight for us, if possible, what's on that watch list, or at least give us a flavor and color on what sectors, if not individual companies that you may have?
Some of them are based on market rumors. No, you see, insurance companies are required by regulation to invest in certain sectors which are socially desirable, which includes housing, infrastructure, which are the two sectors which have undergone severe stress. And that is where we have some of our investments. But some of these stress names are market rumors, that there is a stress in the account. We do not see that either in the credit ratings or in their financial performance. So it will be too premature to comment on those. But to the extent they have been downgraded, even from AA to AAA to AA, we have to disclose it, so that we are disclosing.
Could you just quantify, ballpark, what's the exposure that you would have to housing as well as the real estate segment?
No, it would be housing and real estate. It is of the stressed assets, it's only the DHFL bonds. We would have with a lot of public sector companies which we do not consider as stressed at all. Therefore, it is only DHFL which I already gave the numbers out. Infrastructure, we had ILFS, we are fully provided for.
Okay. Mr. Sreenivasan, let's also talk about your deposit growth. That has improved on a sequential basis. What will be the share of deposits over FY20 on the consolidated book, and how do you see your margins as well shaping up?
You're talking about BFL?
Yes.
Just a sec.
Just wanted to actually understand, the overall outlook on your deposits and, how you see margins shaping up. Is there going to be any sort of concern on that front, or are you confident of maintaining your margins?
See, a few years ago, when we had we would be around 14-15% of our book is now deposits. This is one area which we have been growing over the last 4-5 years, and we will continue to stress on that. We have increased the number of locations where we offer fixed deposits to our customers. So after this liquidity squeeze of the last 1 year, we have seen that there is a demand for high quality paper like ours, and therefore we expect a lot of demand for fixed deposits going forward. Over the next 2 to 3 years, we want to increase the share of deposits in our overall book to diversify our liability base. I can't give you an exact number, but we would want to be significantly higher than where it is today.
Okay, well, we'll just continue with BFL in a moment, but coming back to the insurance side, motor insurance currently accounting for 42%. We've seen a slowdown. How do you see that impacting premium profit growth for FY20? Give us a sense of how things stand.
See, motor has multiple segments. We have passenger cars, we have two-wheelers, and we have commercial vehicles. In terms of new vehicle sales, as you have correctly mentioned, there has been a slowdown in growth over the last several months. However, the insured pool includes a lot of the vehicles which are already on the road, including which are already insured with other companies. Last year, after the Supreme Court mandated that new cars should have 3 years of third-party insurance and two-wheelers 5 years, I think a lot of the uninsured vehicles, especially in the two-wheeler segment, now are automatically insured. So that led to some growth. As far as the pricing in motor is concerned, yes, there is pressure on pricing. It's not new for the market. I think for the last several years, we are seeing significant competition on the own damage front. On the third party, the price is controlled by the regulator. They have given a modest increase from 1st of July. So we will have to see how it pans out. But our third party portfolio related to market is significantly better. Our loss ratios are lower. So on a consolidated basis, we are quite optimistic about the profitability of the portfolio. In terms of growth, yes, it is a business of selection. We will continue to monitor where there are pockets of upward moving loss ratios, and we're correcting them. That's what we have been doing for years, and our general insurance company will continue to do that over the next 3 quarters.
Shift to life insurance now, because while premium growth has been strong for you, how has VNB and new business premium margins shaped up, and what would you say has been the growth in embedded value?
See, we publish that only once a year because the first quarter for the life insurance is very low. But last year, FY19, we reported new business margins of about 15.6%. And after a few years where we had large overruns, we were able to report positive net margin of about 6.5%. The new business value had grown by almost 54% last year before the overruns. And as of now, in the first quarter, we seem to be on trajectory I'm on the same trajectory now. Unfortunately, the profit and loss account of a life insurance company is affected by 2 factors. As you grow, you will have a new business strain, so your profits actually come out of the renewal book. But I'm happy to say that our renewal book has recorded 29% growth in this quarter. Our overall new business premium has grown 41%. And most importantly, I think we had diversified our product mix away from ULIP a couple of years ago, and now we stand at 61% ULIP and 39% traditional business, and that is helping us quite a lot in giving balance and sustainability to the portfolio. So life business on all parameters, in terms of quality of business, in terms of growth, in terms of margins, in terms of product mix, has done very well. On the profit and loss account, because of the provision for DHFL, unfortunately we have had a degrowth in profit. If you exclude that provision, actually we would have, after several years, recorded actually an increase in profit after tax for the quarter.
For the benefit of our viewers, can you tell us a little bit more about what impacted profits in the life insurance business?
See, one is the new business strain, as we call it, because we are growing very strongly. Our new business has grown by more than 40%. So clearly, as you write new business, the first year is a loss. So to the extent of the growth, you will have a loss. Secondly, we have that provision for DHFL of 126 crores pre-tax, which I mentioned already. But for these, I think the underlying business is very strong. New business value is the correct measure, and that we are on track to record reasonable growth in that in this year.
What's the update on the Allianz JV in both the insurance business? The management so far has maintained that Allianz continues to be a partner. Is there a case for the JV being pulled off, or looking at any other partner in the insurance business?
No way. I think there is nothing on the cards on those lines. Allianz continues to be a strong partner, and we are deeply engaged with them on a regular basis. They have reiterated their commitment to India and to the joint ventures.
Sreenivasan, now let's shift focus to Bajaj Finance. While the management has clarified to the media that Bajaj Finance will be raising a capital of $1 to $1.25 billion in the second half, help us understand what really is the rationale of this capital raising when you just raised capital about a year and a half back?
You see, capital is required to support growth. On a normal basis, if we are growing at 20-25%, given the profit margins that BFL delivers, capital would not be required. However, they have been growing significantly higher than that. We look at several things when we want to decide on capital. One of them is our leverage ratio. Compared to many other, the average of the NBFC sector, we normally tend to be a little bit more conservative on leverage. So we never allow it to go beyond 7. And moment it crosses 6, we start looking at what are the alternate means of funding. So therefore, although every time we raise capital, we think it will last us for 3-4 years, the company's performance on the growth side has been so strong that sometimes we may have to do it a bit earlier. And we are looking at that option maybe later in this year if we continue to grow at this rate.
The management has said in the investor presentation yesterday that they've talked about tighter underwriting standards. Will that also mean then slower AUM growth going forward?
Not necessarily. You see, we are not slowing growth. I think that is not the objective of the management. And I think if you look at historically the last 10 years of BFL, what BFL has been good at is to be able to find early warning signals, and underwriting standards keep changing depending on the market conditions. This is not a high level change. These are small micro changes you make on each portfolio to ensure that credit quality is of the type that you want. Now, the external environment today, there are a lot of uncertainties. As you have seen, there has been muted growth on automobiles and some parts of consumer discretionary spending. In such a situation, it is natural that cash flows in the economy will get tighter, and we are preparing ourselves by tweaking some of our underwriting standards to ensure that the business quality remains the same. Having said that, the management has also confirmed yesterday that 65% of the business is to existing customers, which means that we already know the credit quality of those customers. So this is a very intense micro level exercise which the management does in a very precise fashion to ensure that we maintain the balance between growth and profitability. But managing risk is very underlying, is the essence of management of an NBFC, and BFL has shown that year after year.
Oh yeah, absolutely. You know, the markets also appreciated that given the kind of environment when just about every company is sounding off the red flag and cautionary note, why not you? It's only prudent to be like that. But Aman, I believe you have another question.
Right, Mr. Sreenivasan, just wanted to get in a view on the housing finance subsidiary. Profits here have improved. Can you tell us what is the state of the asset quality here?
We practically have no NPAs in the housing finance subsidiary as of now. We are a very small player in housing finance. Our AUM is just 21,000 crores there. but it is something we want to develop into a low-cost, profitable housing finance entity. All the risk philosophy of the group will continue in the housing finance company. It's too early to say. The profits are, given that they have been in business only for about 18 months, the profit they have generated is, we are very satisfied with the performance of the housing finance company. And it's the largest pool of lending assets in the country, probably the lowest risk in terms of the salaried finance and the individual retail finance. And that is the area where we would predominantly be focusing on that. I think it will take another 2-3 years for that company to really come up because it's a startup entity. Let's see how it goes.
With both real estate as well as consumption demand slowing down, and real estate has been languishing for a while now, do you sense that your AUM growth could be slower than 40% going forward? Is that a possibility? Would you not rule that out?
See, I would not be able to, I don't have a crystal ball, but all I can say is that when times are tough, demand for money actually increases. And where lenders have to be cautious is on the lending side, who you want to give to. So therefore, there are many borderline cases which in good times, where cash flows in the economy are very strong, will do very well. So there you will prune a little bit. However, we are a very small part of the whole lending system. And therefore, the size of the opportunity is very large. We have a very large customer base. We have a large cross-sell base. And therefore, we are very confident that, we will be able to beat the market going forward.
Maintain the AUM growth in the range of 35 to 40%. Yes or no?
No, we actually always give a guidance that our target is to grow AUM at about 25-27%, 3-3.5% return on assets, and an 18 to 20% ROE. However, depending on the economy, you could have volatility and beta factors playing, which means that sometimes you deliver significantly higher than that. It so happens that for several quarters, quarter after quarter, we have been delivering higher than that. But as management, we would not like to give that kind of prognosis.
So much for joining us this morning and taking us through those numbers in great detail. Thanks so much for being with us.
Thanks a lot.